Welcome to the
distinguished guests. We wish you a warm welcome to this year's high-level conference of the National Bank of the Republic of North Macedonia, co-organized with Reinventing Bretton Woods Committee, entitled Central Banks and Central Banking in a Highly Complex World, Demonstrating Commitment and Preserving Credibility. As we are all aware, central banks' independence remains vital for maintaining price stability and for bolstering confidence in the financial system. Therefore, safeguarding the central bank independence and credibility alongside exploring their mandate's perspectives will be in the spotlight of today's conference. Such issues gained prominence, particularly in light of the expanding scope of tasks undertaken by central banks in this ever-changing and challenging environment, raising pertinent questions about how these new responsibilities affect the effectiveness and capacity of central banks in fulfilling their primary mandates. Moreover, the conference will reflect on the lessons learned from the most recent global inflation episode, and we'll hear from chart a course for the future. These topical questions relevant for the region and beyond, as well as the presence of highly distinguished and experienced speakers, usher in a truly interesting and effective conference we hope will be enjoyable to all. At the beginning, we invite Mr. Mark Uzan, Executive Director of Reinventing Bretton Woods Committee, to deliver his opening address. Mr. Uzan, the floor is yours.
Macedonia, in which we are very honored to co-host again this year. Let me start by thanking you for joining us both virtually and in person. And I would like to extend my gratitude to the distinguished speakers, panelists, researchers, who have agreed to honor us with their contribution to this event. And last but not least, a thank you for all goes to all the people involved in the organization of this event. Let me start with the current state of the global economy. On the positive side, the world economy has proven to be quite resilient to the multiple shocks of the last years. Inflation generated by this shock and the response to them is finally receding. Major economies are poised to avoid the recession that many fear will take hold. Nevertheless, the global economy is facing several headwinds with protracted geopolitical tension that are affecting trade and investment. Non-market policies are leading to the global spillovers, market distortions, and overcapacity in a range of sectors. Where we find ourselves now is an environment where the risk of global fragmentation has increased. This has been due to a combination of factors. First, growing concern around the disruptive effect of globalization, in part due to the rapid shift in manufacturing activity away from advanced economies. Since the mid-2010s, this concern translated into waning political support for further trade integration in some economies, as evident, for example, in rising trade tensions between the US and China. Second, the COVID-19 pandemic, which led to several disruptions of global supply chain. This led to the questions around the resilience of complex supply chain when unexpected shock hits. Third, Russian invasion of Ukraine and its people, which deepened crack in the global economic order. It also exposed Europe's resilience on energy supply from Russia, raising broader questions around the national security risk associated with geopolitical dependence for critical goods. There are indeed growing signs that the potential risk of fragmentation. There has been a sharp increase in the number of trade and FDI restrictions since 2018, and FDI flow appear to be concentrating among geopolitical lines, particularly in strategic sectors. And mention of reshoring, nearshoring, friendly shoring have become increasingly frequent both in public discourse and in companies' own reporting. Fragmentation also reflects the rapid escalation of climate risk and disasters. With once-a-lifetime flood, mega-fire, and drought proliferating, many countries are at risk of destabilization within the next few years, and there is no global financial safety net in place. Countries are competing for dominance in green technology rather than working together to accelerate progress. All of this, of course, will have far-reaching implications across many domains of policy making. And indeed, today's conference will explore what are the implications for central banking and for central banks. Central banks are facing a number of substitutional challenges in their various business areas, like in many sectors of the economy and in economic policy making, are undergoing fundamental structural changes. The inflation outbreak that follows the COVID-19 pandemic and the onset of the war in Ukraine was a reminder how quickly the macroeconomic environment can change. The trust that central banks have gained around the world over many years in keeping inflation at bay could have been lost if society has started to doubt about their commitment to price stability. Some generation experience for the first time the risk of the economic transition to high inflation regime. Once that transition starts, it becomes increasingly difficult to stop. Therefore, to restore price stability, it was necessary and appropriate for central banks to tighten policy decisively through higher interest rates. Another long-term change in the macroeconomic environment is the high level of public debt. If used appropriately, public debt allows government to function effectively. Yes, it is important to public debt and it seems to be sustainable. Any hint that the government might resort to central bank financing to meet its financial obligation can threaten monetary stability. In many economies today, therefore, fiscal consolidation is needed. It is needed not only for fiscal sustainability, but also to preserve trust and the effectiveness of an economic macro-financial stability framework. Central banks also face other strategic questions. What will be the future monetary policy toolkit once a new normal has been reached with inflation back to establish inflation target, while the geopolitical and economic environment will likely remain challenging? How to deal with persistent high uncertainty in the age of polycrisis and how monetary policy will be affected? How will the digital transformation and AI will affect monetary policy? This is a typical example of innovation where central bank will be mistaken to wait. Early this year, the IMF went to a preliminary estimate where almost 40% of jobs around the world and up to 60% for developing economies may be affecting with AI, acting either as a substitute or as a complement to labor. Central banks should rapidly start adopting new technological innovation, including AI, in a rational, clear, and controlled way. And indeed, many central banks are already using AI as a street to deliver on their mandate. It is used to forecast inflation, economic activity, to track the sentiment in key sectors of the economy, to try to verify regulatory data, and to improve efficiency and de-risk their operation. We are indeed in the early days about what could be a transformative technological shift. For central banks, that means maintaining price and financial stability in the face of disparative technological trends. What role for central bank as risk manager? Are central bank finance relevant for central bank independence and their ability to deliver on their price stability mandate? What are the interrelations between monetary policy and structural change? Do central banks have a role in facilitating certain structural reform? Climate change, of course, emerged as a major challenge over the last few years, including for central banks, given its impact on the economy, on the financial cycle, and on inflation. It is not about long-term risk. Think of the drought that we have in Europe, the flood of Brazil, in Greece and Germany. Nevertheless, central bank and green finance might not be able to replace sound public policies and corporate transition plans. As we navigate through uncharted territory and confront the political challenge facing the central bank, can we keep the central bank of the future to navigate unforeseen challenges? I'm very confident today, with all the governors who are here for this conference, that many of these topics that we are going to discuss through this conference will resurface in one form. I wish all of us a good conference with many ideas to share all together. And thank you again for your hospitality, Governor, for making all of us here participating to this event. Thank you.
Thank you, Mr. Uzan. Thank you, Mr. Uzan. And now we invite the Governor of the National Bank of the Republic of North Macedonia, Anita Angelovska-Bežovska, to present her opening speech. Madam Governor, the floor is yours.
Honorable President Sijanovska-Davkova, dear governors and speakers, Mr. Uzan, Your Excellencies, ambassadors, representatives of the academia and media, ladies and gentlemen. It's my great pleasure and honor to welcome you and address you at a high-level conference co-organized with the Reinventing Bretton Woods Committee. It seems that the conference comes at the right moment to reflect on how well has the central banking community coped with the past crisis and look up into the future, which may be equally challenging. And somehow I thought that an appropriate wrap-up on how central banks for good. Obviously, it wasn't the case. After 5 decades, the same enemy, that is the great inflation, returned. This time, however, given the lessons from 70s, central banks were better equipped and their response was significantly swifter, bolder, and more comprehensive, including diverse set of instruments which played an important complementary role to the main policy instrument. This was in particularly the case in the emerging economies, including our region. This extremely complex context was not only a test of the central bank's analytical capacity, but also a test of their resilience to withstand the potential interference and threats to their independence. High inflation was eroding the household purchasing power. A rising interest rate was unpopular, yet necessary measure. It was additional burden for those with high leverage, both private and public entities. And in many cases, leverage was at historically high level following a decade of ultra-easy financial conditions. This implied that central banks were not able to enjoy anymore the so-called capital of inattention, as they were now in the spotlight of the public policy discussions. For illustration purposes, while before the inflation spike, 55% of the euro area citizens were not interested in the ECB and its policies, afterwards 60% started paying more attention than in the past. The interest in central banks gained even more ground, as in the last decade they have been entrusted with many new tasks, some of them having even distributional effects, which in principle increases the risks of pressures from different lobby groups. Thus, many stakeholders started bringing to focus the suitability of the central bank's policies and even the rationale for their independence. Central bank independence became a globally accepted truth of economics about 30 years ago. History taught us that whenever central banks tried to directly or indirectly accommodate other needs, be it stimulating economy or debt financing, the result was high and lasting inflation. Research points that only independent central bank can maintain its credibility and keep inflationary expectations anchored and thus prevent opening up of a wage price spiral. It is thus important to avoid even the appearance that fiscal considerations might be dominating the monetary policy. According to the latest central banking survey, about 87% of the central banks believe that their governing laws sufficiently protect their independence. In our case, independence provisions are enshrined in the Constitution and in the law on the central bank, which, according to the EU, is assessed to have a high level of alignment with the EU acquis. An adequate legal framework, for sure, is necessary, but not sufficient. In practice, the context might be more complex, underlining the importance of resilience and integrity of the central bank's management. Still, independence cannot be a free lunch. It has to go hand in hand with central bank accountability and transparency, which in fact have increased over the years. As Blinder says, whereas in the past central banks believed in secrecy and even mystery, greater openness is now considered a virtue. And greater openness is the key for convincing the public that central banks act in public best interest, especially at times of huge uncertainty, forecasting errors, deviation from targets, speculations on the exchange rate and on the banking system. Our central bank, faced with all these challenges, including speculations that contributed to the loss of 15% of our official reserves in 2 episodes in the last couple of years, has significantly stepped up its transparency and communication, guided also by the IMF Code of Transparency Assessment done in 2020. Recent shocks have once again reconfirmed that independent and credible central banks are the backbone of the proper navigation through economic turbulences, with already visible results. Disinflation policies, alongside dissipating stress on commodity markets, calmed inflation to low single digits. In the CE region, latest inflation readings point to inflation of around 3%, strong adjustment compared to 14.3% at its peak in late 2022. In our case, inflation has come down to 2.2%. Inflation expectations have also stabilized. Looking at different market and survey-based indicators, we can broadly infer that the anchor has survived the inflation spike, and it has brought down close to the pre-pandemic levels. While inflation was at the core of the central bank's actions, it was also important to calibrate policy response without dragging economies into recession, that is, having as smaller as possible sacrifice ratio. While in 70s, 80s, it took 2 recessions to stabilize inflation, this time is different. Although monetary policy operates with lags and it might be too early to draw conclusions, data point that hard landing in the CEC region has been avoided. Indeed, growth rates decelerated last year to about 2.7%, but importantly, all the countries avoided contraction. Last but not least, price stability has been achieved without costs for financial stability. On the contrary, financial soundness indicators point to a strengthened solvency and quality of the banking balance sheets in the region, including in the Macedonian economy, where capital adequacy ratio has been highest in the last 2 decades. This, to a great extent, reflects the active use of macroprudential measures, confirming that they notably increase the room of maneuver for the monetary policy in its fight with inflation. To summarize through the lenses of the IMF MD Georgieva, Just consider what independent central banks have achieved in the recent years. While the battle isn't yet over, their success thus far has been largely because of the independence and credibility that many central banks have built up in the recent decades. All in all, we have managed to ride out a major storm, but a storm that transformed global landscape and scarred our economies. Hence, going forward, monetary policy may well face an environment no less challenging than the one that has prevailed in the past decades. In this vein, there are several issues that I would like to quickly bring into the spotlight. First, it is the inflation dynamics. Though the inflation is brought to low single digits, the sectoral dynamics of prices shows stronger persistence in services inflation, with core inflation hovering around 5%, being only 48% below its peak. This, no doubt, underlines the importance of appropriate wage policies, in particular when CEC region observes a nominal and real wage increase hovering around 15% and 10% respectively. The second issue that deserves attention is the monetary fiscal nexus. The recent shocks underscored that monetary policy is powerful, but it's not without limitations. Therefore, no derailing from the fiscal consolidation commitment will be critical in the forthcoming period, both to ensure fiscal sustainability and to support the monetary policy. The third point relates to the structural factors and their impact on the supply in the economies and their potential to grow. The reversal of the globalization, population aging, climate risk could all lower the productive capacities, making the supply less elastic to demand and thus creating inflation-prone world. Only for the risk of geoeconomic fragmentation, estimates point to a loss in the world GDP in between 0.2% to 12%. On the other hand, the rapid advance in technology, such as entrance of artificial intelligence, could smooth the impact of the above-mentioned adverse forces and elevate the growth potential. These transformations require well-defined reforms to increase the resilience of our economies and reduce the medium-term inflationary pressures. All this just reconfirms that the uncertainty and unpredictability are here to stay, and that global transformation of the economies may take different directions. In such a context, central banks must remain watchful, flexible, and with robust frameworks. It is a fact that central banks have so far risen to the extraordinary challenges, which in a certain way proves that long-standing investments in capacity, independence, and accountability pays off. Yet, we must remain humble as well, acknowledging the uncertainty and complexity of the new reality. At the end, let me close with something said by Winston Churchill back in the past, but equally relevant for policymakers today. This is not time for ease and comfort. It's the time to dare and endure. Thank you.
Thank you, Madam Governor. Ladies and gentlemen, dear guests, we are truly honored to have here with us the President of the Republic of North Macedonia, Gordana Siljanovska-Davkova, who is at the opening of the conference to deliver her welcome address. President Siljanovska-Davkova.
Почитувани присутни, Dame i gospoda,
Guests, ladies and gentlemen, it's an honor to welcome you for this extraordinary conference. Last week at the Summit for the Future in New York, the Secretary General of the United Nations, Antonio Guterres, pointed out that we cannot build the future for our children through a system built 79 years ago in 1945. I deeply believe that we need to reconsider and we need to transform every segment of the international order, including the international monetary and financial order established at the conference in Bretton Woods in 1944. It is not by accident that the topic of this year's conference is focused on the role of the central banks in this modern, complex world. We live at a time of paradoxes, deep interdependence of countries, economies, people, and nature. Social, gender, and digital inequalities among states, inside and among the states is on the rise. Less developed economies, such as the Macedonian economy, dependent on others, feel disproportionately the effects of the geopolitical rivalries, military conflicts, the intertwined safety-related and ecology-related conflicts. It is necessary to find a new model to stabilize the shocks in an ever-changing economic environment. One of the pillars of stability in an unpredictable time is central banks. Central banks are the ones to keep the monetary stability against the two extremes: extreme fear that leads to panic and extreme self-confidence that leads to opportunism. In order for the banks to be able to realize their important role, they need to be independent from the central government for resilience against the pressures, political pressures that become extreme in crisis election periods, such was the 2024, which was the year of elections in the whole history of politics. Actually, independence provides central banks to implement their role in reducing inflation, stabilization of prices, and maintaining macroeconomic stability as a precondition for long-term economic growth. To remind you, in the words of John Donne, there is no man that is an island on its own. Independence of the central bank from the central government should be followed by coordination with other central banks. In this context, in order to protect Macedonian citizens and Macedonian economy against the economic shocks, our national bank adjusts its monetary policies with the ones of the European Central Bank. Still, Macedonian citizens will feel the advantages of the Central Union when the trading integration will be accompanied with the political integration through European reforms by respecting the European standards and criteria. Integration will help us build a more inclusive and more just society where men and women will be able to equally advance based on their knowledge and skills, their competencies. For us, unfortunately, We were deprived of the right to progress and advancement, not because of the Copenhagen criteria, but because of the demands of some neighbors to revise the history and disrespecting our cultural identity. As a consequence of this injustice, young people who are our key driver of our economy immigrate in order to not to lose the most valuable resource, our young people. We expect from the European partners understanding and deblocking and liberalization of the negotiation process for membership in the European Union, using the same standards for all, respecting the law, the international law, the European principles established in the constitutional acts. Only by full integration in the European Union, the Balkan region, instead of being the Achilles heel, will become one of the pillars of stability of Europe. It is time to reform the international monetary system. The smaller states should be incorporated on an equitable and equal position as the first Macedonian female president. I believe that changes also tackle women, and that women are not only for bringing changes in the United Nations, but also reforming the international monetary and financial order. At the very end, I believe that this conference is a great opportunity and a challenge to give authentic regional view and interpretation of these important issues. I wish you a fruitful and successful work. Thank you.
Thank you, Madam President, for your inspiring words. Dear guests, it is now time for the first keynote lecture delivered by Alfred Kammer, Director of the European Department at the International Monetary Fund. Mr. Kammer, the floor is yours.
Madam President, Governors, Your Excellencies, ladies and gentlemen. It's a pleasure to be here at this important conference. We gather at a crossroads in our efforts to restore price stability. In many countries, headline inflation is back to more comfortable levels. Moreover, the extreme uncertainty surrounding our economic models has receded. This means that monetary policy can again be guided more by forecasts, and it can look through short-term variation in current data. However, in other countries, the outlook is less certain. There, high inflation and sticky core inflation are reminders that our mission is not accomplished yet. Efforts to reduce inflation over the last 2 years have reasserted a crucial tenet of central banking: stay to your mandate. Yet, this should not prevent us from asking if and how monetary policy strategies need to adapt in the future. I will structure my remarks as follows. First, I will revisit how central bank frameworks have contributed to economic stability, particularly in the Central, Eastern, and Southeastern European region, the CESE region. Next, I will discuss how recent events, in particular Russia's war in Ukraine, have tested the resilience of central bank frameworks and the calls on central banks to expand their mandates to address wider societal changes. And finally, I will provide a few thoughts on what lessons we can take forward. Let me start with central bank frameworks. We are used to seeing central banks primarily as guardians of price stability. This is certainly at the core of their business. But many central banks had, and some still have today, a much broader range of responsibilities that goes well beyond price stability. In Europe, for example, Banca d'Italia acted as buyer of last resort on the primary market of Italian government bonds from the 1970s until its divorce from the Treasury in 1981. Similarly, after World War II, Banque de France was granted extensive powers to influence the allocation of credit to the economy and fulfill a range of economic policy objectives. These were not isolated cases. Credit control policies were widespread in the post-war era in Western Europe to steer credit towards specific industries, accelerate industrialization, and foster higher growth. But central banks have evolved over time in response to changing conditions. Following the oil price shocks of the 1970s, quasi-fiscal functions and credit policies were gradually abandoned in most countries. The broad scope of central banks' mandates stood in the way of securing price stability, which became the primary focus from then onward. Mandates were narrowed, and central banks were granted institutional independence from political influence. This prevented fiscal dominance and the inflationary bias that goes with it. The concept of inflation targeting emerged in the 1990s, crystallizing the evolution of modern central banking. The new paradigm for conducting monetary policy built on strong central bank independence from political interference and combined it with a clear price stability mandate. Inflation targeting also required central bankers to be transparent about how monetary policy decisions were reached and held them accountable for achieving the goals. Central banking independence may be the foundation of modern central banking, but transparency and accountability are what balances central bank independence with the principles of democracy, as the governor has pointed out. Inflation targeting was adopted by several countries in the CESE region, though PECs and unilateral euroization are also common. Inflation targeting helped stabilize inflation, which in many cases converged towards the level observed in advanced economies, and inflation volatility dropped sharply. These successes set the stage for the rapid catch-up in income of CESE economies in subsequent years. North Macedonia is an impressive example. The creation of an independent central bank in 1992 was crucial to bring down the hyperinflation of the early 90s. And by visiting the Central Banking Museum yesterday, I was reminded that times can be bad and bad for the population. So I saw a 100 dinar note next to a 1 million dinar note, and going from 100 to 1 million was in a quick succession of time and devalued the savings of the population and created huge hardship. Now the National Bank ranks very high at the IMF's new Central Bank Independent Index, and that's a big success. Across the world, inflation targeting frameworks were the basis for a period of unprecedented economic stability and growth known as the Great Moderation. Surely, other factors contributed to this outcome. One was globalization. And for several CESE countries, structural reform tied to EU accession played an important role. But the ability of central banks to operate independently from government intervention in the pursuit of price stability is generally viewed as a key pillar of the Great Moderation. It paid dividends in terms of economic stability, growth, and prosperity. Yet, independence has recently come under increasing pressure. We have seen more calls for premature interest rate cuts and more political interference in central bank decision-making and personnel appointments. These pressures risk jeopardizing the successes achieved, and they must be resisted. Let me now turn to my second theme, how recent developments, in particular Russia's war in Ukraine, are testing the resilience of central bank frameworks. First, inflation. The war in Ukraine has been a major supply shock. The sharp increase in inflation hit businesses and households. Effects in the CESE region have been larger than elsewhere. This reflects the high direct exposure through imports, higher food and energy share in the region's consumer basket, and second-round effects on other prices and wages. And while inflation has come down, higher prices and input costs have left CESE countries with a potential competitiveness problem. But there's a silver lining. Unlike in the 1970s, inflation expectations have remained largely anchored so far. Our research shows that this time around, tighter monetary policy lowered inflation successfully by preventing cost shocks from becoming entrenched. This is in line with the historical record. Analyzing 100 global inflation episodes, we found that monetary policy action is essential in disciplining inflation, and that central bank independence helps achieve this with lower output losses by keeping inflation expectations anchored. This is also the approach the National Bank of North Macedonia followed. After inflation surged to a peak of 19.8% in 2022, the central bank's decisive policy rate hikes and strong credibility helped anchor inflation expectations. By August 2024, inflation was back down to 2.2%. The second economic challenge facing central banks is fragmentation. Globalization had slowed well before the war, but the war has contributed to new fault lines, shifting the world from a highly efficient globalized trade model to one marked by regional blocs with increased trade restrictions and higher transaction costs. Indeed, World Bank data show that almost 3,000 trade restrictions were imposed last year. This is 5 times the amount seen in 2015. A less integrated global economy is poorer, more prone to shocks, and exposed to higher inflationary pressures. Model-based simulation by IMF staff show that the inflationary impact of trade restrictions imposed on various commodities between geopolitical blocs could be large. For example, a ban on energy and mineral trade between a hypothetical China-Russia plus bloc and a US-Europe plus bloc could raise inflation in the US-Europe plus bloc by up to 0.6 percentage point in the first year of the ban. These new challenges compound existing ones: Europe's aging population and stagnant productivity. But fiscal room to maneuver is often limited, and needed reforms are always politically difficult. So it is not surprising that central banks find themselves confronted with calls to expand their mandates to address wider societal challenges. First, climate. This is clearly a macro-critical issue. Central banks are increasingly integrating climate risks into their policy framework. Examples include the ECB's climate stress tests and the ECB's and the Bank of England's decision to prioritize firms with better climate performance in their corporate bond purchase schemes. Second, digital currencies, fintech, and AI offer significant efficiency gains, but also introduce new risks. Central banks must stay ahead of these developments, including exploring the potential of central bank digital currencies. The IMF is providing guidance on this front. And third, financial inclusion, including gender-inclusive finance. By fostering accessible and affordable financial services, central banks help reduce gaps, including gender gaps in financial access. We will return to some of these topics later in the conference today. All of them are important. But let us also keep in mind that broadening central bank mandates can dilute their focus on core monetary policy, invite political interference, and stretch institutional capacity. Given the economic challenges at hand, it will be important to look for possible trade-offs. Central banks' main priority is price stability, and central banks will need to manage public expectations accordingly. Finally, a few thoughts on what lessons can be learned from the extraordinary period we just lived through. I believe that risk management is key. Fragmentation means that we are looking at a world with potentially lower growth, higher inflation, and higher volatility. As I emphasized in my 2023 speech at Sintra, during periods of very high inflation and extreme volatility, traditional macroeconomic policy must adapt and refine the use of its tool to navigate these unprecedented challenges effectively. This means, for example, central banks will have to be more cautious about looking through supply shocks. These shocks can have large second-round effects when inflation is already high, so a more aggressive policy response is warranted. As a consequence, strict forecast-based policy rules, which set the policy rate based only on the medium-term inflation forecast, can become ineffective. When inflation is very high, data outturns provide more informative signals about future inflation. Then, the best strategy is to put greater weight on recent data when setting policy rates. High volatility and uncertainty also call for careful communication and a reassertion of central banks' price stability mandate. Clear communication helps anchor expectation, but it needs to be underpinned by action. As discussed, this requires independent central banks. One way to support this is the impartial and merit-based appointment of policymakers to the central bank's decision-making bodies. What does this risk management approach mean for countries where central banks have already steered inflation back to or close to target, and volatility has come down? In these cases, monetary policy can again increase the weight put on economic forecasts and reduce the weight put on current data. This applies to economies with credible policy frameworks and well-anchored inflation expectation, such as the euro area. However, a more data-dependent and meeting-by-meeting approach remains preferable in many SESI countries where inflation is still further away from targets. Given high inflation persistence and wage growth, the risk remains that upside surprises put upward pressure on inflation expectation. This calls for a continued cautious approach to monetary easing to avoid further tightening and a sharper economic downturn later. Let me conclude. Central banks have come a long way. In many countries, including in North Macedonia, they have made significant progress in reducing inflation following their latest surge. This was thanks to improved frameworks which have enhanced resilience through the recent crisis, but also because of resolute action by central bankers. However, the last mile remains challenging, requiring continued vigilance. Political pressures on central banks have re-emerged, threatening to erode the hard-won and hard-earned credibility that is essential for maintaining economic stability. The road ahead requires both continuity and adaptation. Existing frameworks need to continue to adapt to navigate new challenges. Yet, it is also critical to upholding the core mandate of central banking, balanced by adequate accountability. Central bank independence should always remain the foundation of the framework. It is a vital public good that must be preserved and further strengthened. Thank you.
Thank you, Mr. Kammer. And now, with the introductory part over, we move on to setting the stage for the first panel discussion entitled Safeguarding Central Banks, Independence and Credibility. We invite the moderator and the panelists to take their seats on stage. Thank you.
Madam President, Governors, Excellencies, ladies and gentlemen, good morning. My name is Hervé Joly. I'm the director of the Joint Vienna Institute, the JVI. For those that don't know us well, the JVI is a joint undertaking of the IMF and Austria, and we train officials in the region that are involved in macroeconomic management and the oversight of the financial sector. I'd like to thank the National Bank for organizing such an exciting conference and inviting me to moderate this panel on safeguarding central bank independence and credibility. So, central bank independence generally refers to the extent to which a central bank can implement its policies and tools to achieve its goals without political interference. So it's generally used in the context of monetary policy. It's not about setting the goals, it's about independence, autonomy in achieving those goals. As the previous speakers have said very articulately, the case for central bank independence arose from the 1960s and 70s. At the time, some political pressure on central banks was exerted to keep interest rates low in the hope of keeping unemployment low. But that resulted in permanently higher inflation and inflation expectations. So in other words, it was well established that there was no permanent and stable trade-off between inflation and unemployment. So central bank independence became a way to insulate central banks and monetary policy from short-term political pressures and to increase their credibility. As the previous speakers have mentioned, so this became increasingly the norm in the 1980s and 90s. And this came together also with a clearer mandate to prioritize price stability. And with higher central bank independence came higher accountability. So that is the idea that central banks need to explain better, needed to explain better what they were doing and to what extent it was contributing to achieving their goals. As previous speakers have also said, empirical studies have confirmed that higher central bank independence is associated with lower inflation. But although this has been well established, it's also true that in the past 15 years, central bank independence has been questioned on a number of occasions. And I'm just going to give a few examples. I mean, one is that in the wake of the global financial crisis, many central banks had to implement exceptional measures to fight the risk of deflation and depression. But they were subsequently accused of being too involved in the financial sector and of blurring the lines between monetary and fiscal policy. Central banks were under fire again during the COVID-19 pandemic and following the start of the war in Ukraine due to the inflation surge that was observed at that time, and then again more recently for not lowering interest rates quickly enough as inflation was receding. As was well described by the previous speakers, the latest round of criticism on central bank and their independence has occurred in a challenging context. I mean, in some countries, maybe due to the political cycle when elections are coming. In most of the countries, the economic landscape itself is a challenging one with increasing vulnerabilities, a debate on the mandate of central banks, whether they should take on new responsibilities, and in some countries, actually, central bank losses related to past policies. So in this session, we're going to discuss those threats to central bank independence and credibility, but also what can be done to preserve them, both by central banks and maybe by other players. We have a panel of very distinguished speakers. I have to bend to see them all from here, and I'm going to introduce them very briefly. Directly to my left is Paul Hilbers. Paul has been an executive director at the IMF since 2020. His constituency at the IMF includes 16 countries, many from the region, including our host country, North Macedonia. Before that, Paul worked at the Dutch Central Bank and also was on the IMF staff and has worked extensively on financial sector issues. To his left is Gilles Noblet. Gilles has been Deputy Director General for International and European Relations at the European Central Bank since 2008. Before that, he served as advisor to the ECB president, and he was the chief of his office. And even before joining the ECB, Gilles worked at Banque de France. Further to the left is another Paul. This one is Paul Dermine, who is a professor of EU law at the Center for European Law, and is affiliated to the Institute for European Studies of the Université Libre de Bruxelles. And since October 2022, he has been holding a chair in European law. And then completely at the left end of the podium is Boris Vujicic. Boris has been the governor of the Croatian National Bank since 2012 and was recently reappointed for a third six-year term. His stewardship of the National Bank has won him praise and recognitions from the financial sector and the central banking community, and he was rewarded with the Lamfalussy Award for Lifetime Achievement in the field of finance. So we are going to have this discussion in conversation mode, which means that the speakers are not going to make formal presentations. So I'm going to ask them a number of questions, and we will try to keep time at the end for questions from the audience. So let me start with the first question, and we will start with the first poll, the one directly to my left. So what are, in your view, the main factors leading to higher threats to central bank independence? And is that the political cycle? Is that the economic cycle? Or do you think that there are structural trends in the background that may explain that?
Thank you very much, Hervé. And also let me thank Madam Governor of the National Bank of North Macedonia and the Reinventing Bretton Woods Committee for hosting this, I think, very important event on a very topical issue, which already was illustrated, I think, by the speakers before me. It's a great privilege for me to address you today on the vital topic of central bank independence. Incidentally, I'm very happy that many of the constituency countries that I represent in the board of the IMF are also represented here today on this topic. It's a principle, I think, that has profoundly shaped our global economic architecture. The concept of central bank independence gained prominence, I would say, starting in the 1980s, which is some time ago, thanks to the pioneering work of economists like Sylvester Eifinger from the Netherlands and Alex Kuckerman from Israel, both incidentally countries that I represent also in the fund. And they established that it's crucial, actually, that central banks operate independently from political influence to manage monetary policy effectively and ensure price stability. We should also recognize, I think, the contributions of the Belgian economist Paul de Grauwe, who has deepened our understanding of the functioning and independence of the central bank. So this topic basically goes back quite some time. And I think the topic of the current threats and the current discussion on the issue, I think, is very, very topical. And I want to focus my remarks on the question that you posed, Hervé, which is what are the main threats to central bank independence nowadays? Because the situation has changed over time, I would say. Following the 2007-2008 financial crisis, the tone on central bank independence shifted in advanced economies. The previously strong consensus that we had before that began somewhat to waver, although these questions subsided somewhat again in the crisis that debated. And now again we are at a phase, I think, where central bank independence is under scrutiny in many advanced and emerging economies. And several factors, I would think, contribute to this renewed pressure on the concept of central bank independence. And some of these points were already made by previous speakers. First, of course, inflation has gone up. It is already, I think, and that is the good news, mentioned also, it's already coming down a little bit after the upsurge due to COVID and due to the Russian war in Ukraine. But still, it's an issue, I think, that worldwide we are still looking into very, very carefully. It has also driven up interest rates. And there, of course, we come to the central banks who are responsible for managing inflation also through their interest rate policy. Factors that we should look into are not just headline inflation, but also, it was mentioned before, also core inflation. I think Alfred mentioned that, and services inflation. Because in the services area, we see inflation becoming more sticky than maybe overall inflation. This is one factor that drives the discussion, I think, at the moment. Secondly, and this is a topic that we very much focus on at the IMF, and it will certainly be a big topic also during the annual meetings of the IMF and the World Bank in a few weeks in Washington, is debt, public debt. Public debt levels have been rising worldwide, and that, of course, increases also the risk of what we call fiscal dominance, the impact of fiscal policy on monetary policy, on the room of maneuver for central banks. And this is one of the key concerns, I think, also at the level of the IMF, and it will certainly be debated, this issue of public debt levels in Washington soon. A third factor that I could mention is the heightened vulnerabilities in the financial sector, particularly due to interest rate developments and interest rate mismatches, which may raise the risk of financial dominance. So I mentioned fiscal dominance, but also there may be financial dominance in that the state of the financial sector may impact the room of maneuver for central banks to intervene to counter inflationary pressures. And of course, that particular aspect, financial dominance, is particularly relevant for those central banks who are also responsible for supervision of their financial system. And then a factor mentioned by the President just very recently is, of course, the election cycles. We see worldwide, and this was actually something that was highlighted in our fiscal monitor only a few months ago at the spring meetings, we see in many countries elections come up, elections taking place, elections being prepared for, and that also may put pressure on central banks in terms of their monetary policies as part of the political debate. Now, you may say some of these factors are transitory, and inflation is expected to decline, and that is very much the case, I think, but it will mean that central banks will continue to face challenges, both in advanced economies, but also certainly, and maybe even more so, in emerging markets. So to sum up, I would say that these factors which are relevant at the same time, which is higher interest rates than before, higher inflation than before, fiscal dominance, financial dominance, election cycles, they really put pressure on many central banks globally in terms of their operations and in terms of their responsibility to maintain price stability. So that, I think, were some factors that I could put together. Let me also just make one point about my history as an executive director for this particular group of countries, in particular with regard to North Macedonia. I think one of the first things that happened during my stay was that our managing director came out, and he was also in touch with your governor, came out to really emphasize, also from her perspective, as managing director of the IMF, of the importance of central banks, and that was in 2020-21. And I think since then, the issue has only taken more prominence, more importance. So very much a topic that is worthwhile discussing here today in Skopje. Thank you, Chair.
Thank you very much, Paul. So the economic cycle, political cycle, but also higher economic vulnerabilities in the economy and the public sector and the financial sector. Gilles, what is your take on that?
Thank you very much, Hervé. Thank you also to Governor Bezowska and Mark for organizing this beautiful event with such a very distinguished audience in the panel and on the floor. I mean, I will start a bit with Paul again before coming to the factors, a bit of element of context. When we talk about independence, it's not only an initial issue, it's also an issue of efficiency, operational efficiency. If you have independence, you have more trust from the citizens, and if you have more trust, you fulfill your mandate and your price stability objective more easily. And actually, if citizens have trust, the inflation expectations are more anchored and the job of the central bank is more easily made. And I think we had clear example recently. Of course, we had the spike in inflation over the recent years, and central bank acted forcefully, and I think managed to bring down inflation and to convince citizens of the merits of independence. This independence is, of course, institutional. We all have a mandate, and we have clear provision for the ECB. We are not supposed to take or receive instructions from government or any EU institutions, so that's clear. But as Charles Goodhart said, institutional independence is not enough. You need also what he called a societal independence. So beside the formal independence, which is laid down in treaties or laws, you need a societal independence, so that the citizens, the economic agents, recognize the merits of independence. And when you have episodes where you have institutional independence, you don't have societal independence, then the mandate or the action of the central bank is made more difficult. We have also a series of economic studies showing that with less independence or threats to independence, you have an impact on macroeconomic variables. So Alan Blinder write on this aspect. And you have also impact on market volatility. And there are all sorts of pieces of literature on how the lack of independence can impact market functioning and market volatility. So coming to the factors, I think my answer will be a bit mixed. We have cyclical factors, political factor, and structural factor. And in an environment often of public discontent, which is of course something that is quite worrying. When it comes to cyclical factors, I mentioned the recent spike in inflation, but I could come back to the financial crisis. Before that, we had the Great Moderation, so central bank independence was not a big topic. Then came the financial crisis with big disinflationary or deflationary pressure. Inflation was very low, and in some circles, of course, this created reactions, negative reactions, where independence was threatened by some constituencies, populist parties, and so on, and also citizens. Equally, maybe in a reverse way, when there was the Russian crisis, then inflation, as I said, spiked. Central banks had to act forcefully. There were calls, of course, for not so strict monetary policy by some circles, but again, as I mentioned before, at the end we managed to do quite a good job in that respect, and trust, credibility was preserved. But even if inflation was brought down reasonably quickly, I said reasonably quickly, we still have to keep in mind the impact it had on citizens and the political reaction that it can trigger on citizens. But the discontent from citizens can come from other sources. There has been some, some opinion among citizen, economic agent, or academics that monetary policy could create inequality. And as you know, many central banks had to engage into the purchase of securities on markets and so, through quantitative easing. And some people were saying this quantitative easing is actually bringing inequality because basically if you buy securities, securities holders are people with usually a higher income, so you favor people with higher income compared to other people. I mean, you can do a lot of studies, and the jury is still out whether this kind of actions, let's say, increase or decrease inequality. I don't think you can conclude, but this is another example of discontent that the people can express towards central banks. Another more structural factor is the evolution of the mandates of central banks. So central banks have engaged in new tasks, banking supervision for some. The ECB, for example, engaged into banking supervision in 2014, not on the will of the ECB, but the legislator asked the ECB to carry out this mandate, which we try to fulfill the best we can, but not that we don't want to have this mandate, but it was added to us in 2014. And for some circles, constituency, a central bank should not do monetary policy and banking supervision at the same time. And of course, doing banking supervision is full of risk, reputational risk, financial risk, even legal risk for some banking supervisors. So there have been, of course, doubts about that. Climate change is another example. Some central banks the Bank of England, the ECB, or the Banque de France having embarked onto action regarding climate change, and this creates reactions by observers on both sides, the pro-climate change actions and the people against action against climate change. So we have also this kind of threat regarding the mandates of central bank. And maybe one final point, which is more general. We live sometime in a world of a bit populist ideas, and central banks are perceived as representing the elite people, so there are also this kind of populist reaction against central bank because we are supposed to be elitist guys in their own bubbles. I would stop here. Thank you.
Thank you very much, Gilles. So, yeah, another set of issues like distributional challenges, the evolution of mandates of central banks, populist ideas. Let's ask the second poll for the view from academia. What's your take on the threats to central bank independence and credibility?
Thanks a lot, Hervé. I also want to extend my thanks to National Bank of North Macedonia and the Reinventing Bretton Woods Committee for the kind invitation. It's a great pleasure to be in Skopje today. Let me first state the position I'm speaking from. So the views I'm sharing with you are indeed those of an academic, so someone who is unlike the other panelists external to the worlds of policymaking and central banking. And my views are also those of a lawyer specialized in European law and Eurozone governance with a keen interest in central banking, but whose perspective on these issues are primarily legal and political rather than macroeconomic and financial. Now, when discussing the challenges that central bank independence face, I think it's important to first take a step back and to realize that the challenges that central bank independence is facing are not unique to central banks, but are part of a wider trends in political systems worldwide, which is the contestation of independence as a government technique in general. So it's an essential idea in liberal and constitutional democracies that certain tasks are better performed by independent institutions, which are insulated from the political game. Well, this idea is increasingly contested, and this applies to central banks, but other independent institutions as well, such as courts or regulatory agencies. And the main explanatory factor, in my view, and has just been mentioned by Gilles, is the rise of various forms of populism, the rise of political polarization, and the difficulty with which many political forces have with this idea that certain aspects of decision-making is decoupled from electoral and political cycles. Now, turning to central bank independence more specifically, the main argument I'd like to make is the following. Now, under the modern central banking consensus, central bank independence is part of a broader compromise, a wider equilibrium, in the sense that independence as an exceptional government technique, as a derogation from the normal circuit of democratic deliberation and political legitimacy, must come hand in hand with a strict and a narrow mandate focused on price stability, to which central banks should stick. Now, most emblematically in the constituency I'm most interested in, namely the Eurozone, well, the Maastricht Treaty, which established the Euro and the Euro system, closely connects a very high level of independence with a relatively narrow mandate focused on price stability. Now, under that compromise, central bank independence is only legitimate and only politically acceptable if central banks remain within this price stability-oriented mandate they have been entrusted. So to put it in other words, independence aims at shielding central banks from politics, but it also commands that central banks stay out of politics, stay out of policy areas which imply non-technical, value-based, redistributive choices. Now, what we see is that recent events have put this historical compromise in equilibrium, that is strong central bank independence with a narrowly defined mandate. Recent events have put this compromise under pressure. Overall, we can see that the expectations and the demands of the political class, of the markets, but also of the public in general towards central banks have increased. New tasks, new responsibilities, more or less connected to the historical mandate of price stability, have been conferred upon central banks, leading to a widening of their de facto mandate and, according to some, an overburdening of central banks. So we've discussed the great financial crisis, which has forced many central banks to test the limits of their mandate by, is it right? Okay. So with the financial crisis, central banks have tested the limits of their mandates by developing unconventional programs with strong redistributive consequences and exploring territories at the crossroad between monetary policy and fiscal policy. In that context, some central banks, such as the ECB, have also been entrusted new responsibilities in financial supervision.